Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Welcome you all for a fresh week and a fresh month. So it is on 1st of April between 5 and 5:45 GMT. We are going to review the market, how exactly the market is expected to behave during this particular week, wherein you come across the prime data release like the non-farm payroll, BOE and ECB interest rate decisions, and also ECB press conference, etc. So during this first week of a month, normally they make very big volatile moves. So in anticipation of such volatile moves, how exactly we can still read the market and try to take swing trades. So that is what we are going to do it in this particular 45 minutes of web interactive webinar. So to start with, I'll be giving the expected market moves for this particular week, 1 to 5 of April. Then also I will try to give the market reading, how exactly we can read the market using the live market quote page, and explain to you what are the possible sequence of the market moves we might see today. Then also I'll explain to you the trading strategies, what we have to deploy, because it is the first week of the month and the quarter. The market is expected to make sudden big moves, so we should be able to protect our equity. We cannot just like that take the position and avoid keeping the stop or the hedging order. Then probably when they make big moves, we might incur heavy loss, and that may trigger the market fear. As a result, we might close the position in distress condition. So it is very important that we don't become distressed or we don't become panic, or we should avoid trying to do the crisis management. Rather than we have to plan well ahead of taking positions. So the contingency plans, that in the event if the market goes against me, what I am trying what I am expected to do. The event if the going is good, what I am expected to do. So if you review both sides, then whatever the way they try to move the market, you have already the plan set, so you will be able to incorporate the plan, and as a result the market fear will not be triggered in you. And in the event if the market fear is triggered because of the quick moves in the market, immediately you think of closing the position or hedge it, try to average it, thinking that that is the best strategy possible, without understanding that is inducing you to go to over trading conditions. So most of the traders, when they say that they have lost their account, it is not because of their calculation is wrong or their forecast is wrong. It is all because of over trading and not managing the positions. Equity management is one, and managing the position is another. Equity management, suppose you have got about $10,000, you should be in a position to calculate you should be able to calculate that how much position I can take. And so you calculate that you can take about 1 to 2% of the equity, the positions, and that is the equity management. But position management, that is after taking the position, how exactly the position has to be handled, that is another important aspect. You cannot afford to hold the position without a loss limiting factor or a stop or a hedging order. So that is also the part of money management, but the position management is more important than that of the money management what you talk about. When you talk about money management, many people think that okay, if I have 10,000, up to 9,000 I can hold the positions. That means make 9,000 as the used margin for taking the positions, or the margins for taking position, and 10,000 is the contingency money which can hold all the 9 positions. That leads to over trading. because we all know the market has to make fluctuations, up and down moves. And so if you think that this is the best level to buy, and later on they may show much better level to enter. So in the event, if you fail to understand that the market means swings or volatile moves, then you try to commit as if theoretically derived level is going to be a practical level for entry, and in the event if they exceed that, technically we may call it as a noise, but as far as the trading is concerned, our stop might be hit. So ultimately we need to find out how exactly the stop has to be handled. So that is very, very important in trade management. So let me give you the expected market moves for this particular week. So this week forecast. So on 1st of April, Monday, that is today, swing and firm up moves during Japanese session. Small firming up could be seen, followed by a small dip during start of the European session, and they may firm up towards late European session, and just swings during that of the US session. Market is expected to make subdued moves at the lower level. And if you look into that of the live market code page, you come across the contrarian move is happening now. So Euro has formed the low 1.2772 and 1.2814, the Friday close level, has become the high, and it is about 38 pips negative net change. And USD is also showing negative net change. GBP is also showing negative net change. So they are doing contrarian moves to handle the crosses. And that is also evidential when USD CAD and Australian dollar are showing negative net changes. So you may not come across big trading opportunities today with regard to the majors. Since they are handling the crosses, you might come across quick swings happening in the case of crosses. That too, whenever they are trying to make a downward stop and try to buy, and you see that all the crosses are in negative net changes and excepting one or two. So that shows that they are making the week beginning false move in the case of crosses to start with, and later on they are expected to handle the majors during that of the US session. But still, during the US session they are expected to only firm up and swing and not make any big headway. Then tomorrow, 2nd of April, they are expected to make a downward stoppant during start of the Japanese session and firm up during Japanese session, and a quick rise could be seen during that of the start of the European session, and higher level swings could be seen during European session, and swing and rise move could be seen during that of the US session. Then Wednesday, they are expected to make a quick rise during Japanese session and hold at a higher level, and swing and quick rise during that of the European session, and volatile moves during that of the US session, giving some stories that there could be a drop or a rise, and for that of the interest rate decisions, asset purchase facility, etc. Then on Thursday, they are expected to make a dip during start of the day, and then make a quick rise during European session. Little bit of volatile moves during the late European session and start of the US session. So daylight saving system is on in Europe. So around 12:30 GMT, you will come across the ECB press conference. At that time, they are expected to make the volatile moves and continue the volatile move during the start of the US session and continue to rise on Thursday. Then Friday, they are expected to make a quick rise during Japanese session and swing and quick rise during European session and a quick rise during that of the US session. And from this is the first week of the new month and also the first quarter and second quarter. So they are expected to hold low and try to buy till tomorrow, Then afterwards they are expected to gain the levels. Then from 8th to 12th next week, you could come across very quick rise happening in the market, and they gain the levels in order to book profit. That is a part of the game. So they try to accumulate now, and the next week onwards they are expected to make quick rise, upward rise, that you might come across visible rise happening in the market. And they have done the prolonged consolidation during that of the first quarter with upward move during start of the quarter, and end of the quarter they just accumulated at the buy at the lower level in all, and they are expected to make further rise in the second quarter. So this is the expected market move. Then we will come to that of the market reading technique. So we note down the high and the low around 3:30 GMT in 4 majors and 2 commodity pairs, and also use them as a reference level in order to identify the types and sequence of market moves they could do following the GMT time frame. So for that I have already noted down the initial lows and the highs in all the 4 majors and 2 commodity pairs. Now we will compare it with that of the live market code page. You find that euro formed the low 1.2772 and the high 1.2814. So they are not breached the high or the low. Okay. Then in the case of GBP, 1.5178 is the low, 1.5203 is the high. There, see, from 3:30 onwards, they are only making swings without cutting the high or the low in both euro and GBP. Then in the case of USD yen, 93.83 is the low and 94.38 is the high. So they just made a quick downward move and made the rise up to 94. And then they are holding below that of 94, the psychological level, with 34 pips negative net change. As a result, you come across Euro Yen and GBP Yen are showing negative net changes. Euro Yen again, which is showing a negative net change of 73 pips, and GBP Yen is showing about 58 pips negative net change. So this is how they handle the N crosses by making a contrarian move. Afterwards, they will come to that of the majors. So now they are handling the crosses by doing contrarian moves. Then in the case of USD also, they are not breached the initial high or the initial low. And Swiss franc, 94.98 is the low, 95.27 is the high, they are not breached it. And USD CHF is holding around 95 area. Slowly they are expected to gain the levels as a contrarian move in this particular week and next week also. Then USD CAD, 1.0167 is the low, 1.0181 is the high, and you find that it is showing 1 pip negative net change. They are consolidating here in order to handle CHF Canadian dollar cross, and later on you will find Canadian dollar will be making range bound moves, and USD CAD is expected to gain more levels. As a result, they will handle CHF CAD cross in a big way. Then Australian dollar, 1.0387 is the low, 1.0421 is the high. So here again you come across the negative net change as a contrarian move. So as a result, you find that excepting USD CHF, all other currencies are showing contrarian move or negative net changes. So they are mainly to make small swings in the case of the crosses. So after handling the crosses, they are expected to come to that of the majors from that of the late European session. And so in the sequential moves, you find they handle the yen crosses followed by that of the majors. Then you come across the European crosses and the commodity crosses. Then again they come to that of the yen crosses. That is how they try to make the sequential moves. So at the moment they are handling the yen crosses by making contrarian move. So expected market moves for today, as I explained, that swing and firm up moves are expected during Japanese session, and dip and firm up is expected during that of the European session, and swings at the higher level. A nominal gain level is expected to happen during US session without much of an upward move. And you know that in many of the places it's holiday for Easter Monday, so you might come across the thin volume conditions. Because of that, you might make subdued moves in the market. Then it is the first week of the month and the new quarter. Very volatile and quick rise moves could be seen from that of tomorrow, and so the players gain the levels mainly to liquidate the long position built up during that quarter end time, that is last week. And contrarian moves are part of the game in order to handle the crosses. So when they are handling the crosses, there is no point in taking the positions in majors. We can trade crosses. When they are handling the majors, then you can focus on the majors. And with regard to the session times, okay, I forgot to change it. From today onwards, you will come across the shift in the session timings. So Japanese session is from 0030 to 7 GMT. Then 7:30 to 13 GMT will be the European session. So 7 to 7:30 will be the gap time. So even though Europe and UK, they just gained 1 hour after the daylight saving system, which was incorporated from yesterday, but still in the market the players use only the 7 GMT as the close of Japanese session, and 7:30 is the start of the European session. You can suddenly see the market becomes very active around 7:30 GMT, and then you will be able to find out that they shifted the time zone with regard to the European session from 7:30 GMT. Then US session, already the daylight saving system is incorporated. It is from 13:30 GMT to 20:30 GMT. So note down the session timings for this particular week onwards, and till March you will come till the daylight saving system is on, you will come across this sort of the time frame. They are going to follow it, and once the next winter starts, then probably they will go back to that of the normal time frame. So market is expected to make subdued moves today, and one of the contributing factor might be the Easter Monday, and many of the places it is holiday, so you could come across some contrarian moves to handle the crosses during this particular time frame. So if you have got any questions, you can ask those questions in the chat window, then I am willing to answer to those questions. So basically the derived forecast is a theoretical forecast. So it is statistically derived forecast, and that has been explained to you, and that derived forecast can be used only as a guiding factor, because the forecast is time based. It is not level based, it is time based. So in the forecast you come across the expected market moves for the 3 sessions of the day. So they are mainly to give the importance to that of the timings, because the market timing is more important. And you know that many of the players or many of the traders say that the market timing for entry and the exit is very important in order to become a successful trader. So based on that particular criteria, I just worked out how exactly the timing could be established, or we can give it as a forecast. Then whatever the prevailing levels during those timings, one can enter and exit out of the positions, and you should be able to see the profit. So rather than simply becoming bearish and bullish, so if they are near that of the low, that is what the trading strategy I just explained, and also many times. So when they are closer to that of the low and not breach the low for more than 30 minutes, one can take a buy, and afterwards towards close of the session they will try to go to that of the high, book profit. if you find that the profit might be hardly about 10 to 15 pips, then wait for the next session to come. And definitely they will try to make a downward stop and followed by that of an upward stop and. So during the downward stop and, if you identify that it is only a stop and it happens in less than 30 minutes, and they come above that of the initial low in less than 30 minutes, you can take a buy. And out of experience, you will be able to find that in first 10 minutes they will form the new low and stop cutting the new low. Then at that time you can straight take a buy during such stop and when they gain and go above that of the initial high, and in 10 minutes they stop cutting the high, new high, then you can simply exit out of the position. And after 30 minutes you will find that they will come below that of the initial high, because they have to necessarily make the swings in order to induce the traders to commit the position. Then afterwards they widen the swing. Instead of about 20-30 pips, the spread between the high and the low, they gradually increase it to 50-60 pips, 70-80 pips, 100-120 pips, 200-400 pips, and things like that. So during this particular week, they try to make such volatile moves in the market, a sudden drop and a sudden rise, and they are all mainly to trigger the emotions of the traders. So if the traders use their common sense, when it is available cheap, we should buy, and still it can go below, so use the hedging or the stop to limit the risk. And we may not be able to theoretically calculate the exact level where the market is going to bring in a reversal, intraday reversal. And you might think this is the low and try to type buy near the low. They may make another 4-5 pips downward dip. And if you think that, oh, the support is broken and market is coming down, if you liquidate, you may see that it is going up. So theoretically, it is next to impossible to calculate the exact turnaround point. And in case, if you come across new levels are shown, you can always use the excuse that they are all noises. But actually, in practical trading, the level to enter, one may not be able to enter at the lowest point for the day and exit at the highest point of the day. It is next to impossible. Probably by chance you might get it, otherwise not. So only we can do it near that of the low, you buy, near that of the high you can exit. That's what you can do it. And if you become greedy and try to get the fine-tuned level or theoretically estimated resistance level, you want to exit and things like that, the market may not go up to that, or sometime it may breach the resistance and go. Every time you will come across new experience. So the best way to handle it, after taking the position, keep stop at entry once the position makes profit of 25 pips, and once the market goes up, and stop cutting the new low for 10 minutes to 30 minutes, you just exit out of the position. And market continues to give trading opportunity. And in the next session when they drop, again you can enter into the market and exit out of the position. So if you think that, no, I have taken a fine level entry, so I will try to hold it for a prolonged period without taking any contingency plan, then they may show loss and you may become panic, because when you thought that that is the lowest level and taken the buy without even keeping stop at entry, when they go below and when they are shown about 200-300 pips profit and suddenly dropped and show below that, you become demoralized and cut the position, and later on you find the market is really making the rise. So if you use the hedging order, you will be able to, in the event if the position is hedged, you will be able to review the current market level with that of the position what you are holding it, which gives straight away a clear understanding whether the hedging was filled during that of the downward stop or whether it was filled and showing profit. The hedging is showing profit for more than 30 minutes. That means what you have anticipated as an upward move, which is not happening, and then you let that take the market downward any level they want, and your position is hedged, keep stop at entry and let them drop it, and later on they have to reverse the market. They cannot bring Euro to 0 or GBP to 0. They can only drop and rise alternatively. So once they rise, you can just watch and book profit, or you can stop out at entry in the hedge and continue trading with a buy position. Otherwise, if you think that the market has gone elsewhere and your position is not good to hold, you can simply close the original buy with 30 pips hedged sell position, and still you will incur only 30 pips loss. Instead of keeping stop, you can keep the hedge and take a decision later on. Okay, it is not worth holding both the buy and the sell which are hedged. Simply close it with 30 pips loss, because that you have already accepted, and that much of loss you will be able to bear it. And once you see that position, the hedge is not at all making any loss, continuously making profit, you can straight do sell and buy trade there and try to recover the loss what you have done it. So there is no need of asking anybody whether the market is bullish or bearish, because there are only two types of people in the market. One is holding a buy position, another one is holding a sell position. So if the buy position holder is not in a position to book profit for about 2 hours to 2 days, that means the market is going against. And if a sell position holder, even though it might be a low level sell, and he is not stopped out at entry, that shows very clearly the market is on the downtrend, then you trail the stop and taking a sell, keep stop at entry, trail the stop and maximize the profit on the downside. So we have to find out whether the buy and sell trader is making profit at a given time, or a sell and buy trader is making profit at a given time. So if you have the hedge, you are actually holding a buy position as a buyer, a sell position as a seller. Then you will be able to really review objectively whether we have to hold the buy side or the sell side. Then close whichever side which is not making profit, then continue to make profit on the other position. So this is the objective way of earning money. And simply telling that, no, as for the forecast, the market is expected to go, but it has gone against, and so I'm incurring loss, that is not going to help anybody. So ultimately, you have to use your trading strategy and see that you make net profit out of that. Forecast is nothing but a derivation, and the derivation is nothing but an expectations. And we do expect so many things to happen in life. So you go to the bus terminus and expect the bus to start a specific time. It might be delayed, or the bus might be cancelled, and there can be so many things could happen between the cup and the lip. So there is no point in blaming anybody other than tuning yourself to that of the current condition. Then think of an alternative and try to take that particular alternative method. So if you don't become panic, only then you think of alternative. If you become emotional, then you get the mind block and you are not in a position to think properly. So these things are very essential in life as well as in trading. So let me answer to the questions which are asked here. Then Chowkiat. How low will you expect the Euro GBP cross to reach in this week? So Euro GBP cross, if you see that it has already come to 84 area, and it is come to 84.16, 84.11 is the low, and they could make either way stop-ins during today and tomorrow and increase the range, and afterwards it is expected to go to 82 area. And in that process you will find GBP is expected to gain more when compared to that of Euro. Now you find that GBP is showing positive net change, Euro is showing negative net change. So this is how they simply hold GBP. Initially they dropped GBP to create the market sentiment, and subsequently they are holding GBP and they are dropping with some other story in the case of Euro. These are all nothing but drop and buy strategy of the players. So it may appear to us they have shown the new low, so market has become bearish, etc. And that is the main strategy or the sentiment change they bring into the market by showing the levels. So if you focus more on the levels, then you are bound to become affected by such market sentiments. Instead, if you think that, okay, market has dropped from Friday close only about 31 pips. So whether I buy it at 1.2789 or I buy it at 1.2579, if I use 30 pips hedge order, I can only face 30 pips loss. Nothing more than that. So if you give again and again importance to that of the levels, then you fail to understand that the risk limiting factor is always 30 pips, or any stop you decide, that will be the risk limiting factor. So you may think that this is a good level to buy, and not all 100 times you might come across that level what you estimated is correct. So if there is an error of entry, say for example even 1% or 5%, and if you then think that, okay, I have to fine tune my entry and do all sorts of analysis, the market may not wait for you to enter into that. You may become an expert in technical analysis, but you would have failed to enter into the market at the appropriate time. Hence, I want your studies to be very simple. Whatever I am just showing it in the live market code page is nothing but the incorporation of the technical analysis of various type of analysis, what you do it as a conventional statistical analysis. So when they stop cutting the new low for more than 10 minutes to 30 minutes, you find if they come above that of the initial low and stay there for 30 minutes, they intend to make 100% rise without any doubt. You just watch it. Then you will be able to really understand. So now they just cut the low in the case of USD yen. From that of 93.83, they just formed it as 93.79. And it's a brief stop, and they are trying to do it towards close of the mid-session. Then afterwards, they are expected to gain the levels in the case of USD yen as well. Already they are gained in GBP, and later on they will gain it in Euro and then USD yen. Also they are expected to gain the levels in the case of Australian dollar slowly during this particular day. Then YASA. What can we expect of Australian dollar? Australian dollar has got the potency to go up to 1.06 level. But not today, during the course of this week. I am holding buy at GBP yen at 142.85 Nagaraj, and USD yen buy on 93.85. Is that a good entry? Yeah, any level can be a good entry at a given time, and later on if you hold without any risk limiting factor, it may become a bad entry. Always keep it in mind. Once a position makes profit, try to keep stop at entry so that you don't incur any loss. The loss prevention is a strategy, and you might be afraid that if I keep a stop, they may hit my stop and go up. No, they are not in a hurry to make such moves. If they hit your stop, definitely they will show you a new low, and fine tune your entry and enter there. You will be able to really see that that entry is giving the profit. So don't avoid keeping stops. That's what I humbly request. A good entry can I hold also Australian dollar 1.0398. They are around these levels now, so they are bound to make a brief downward stop and during late Japanese session and then go up. So you should be in a position to watch that and try to enter the market and see that you don't overtrade. Because when you say that you are holding position in too many currencies, it indicates you have got a tendency to overtrade, and that you have to avoid. Namibia. How do you distinguish between extended move and extended stop? And extended move is only for about 2 hours, and they could do about 30 to 60 pips on the downside or on the upside. Then extended stop and is necessarily for about 150 pips minimum, and reverse in a matter of about 2 hours to 3 hours. Earlier they used to do it in 30 minutes time frame because of the volume constraint. Nowadays they are taking about 2 to 3 hours to reverse and come back to where they started. Now, say for example from 1.2772 they simply drop it to 1.2672 or 50 and then reverse in a matter of about 2-3 hours 1.2772. That is an extended downward stop, and before making a big upward rise they do it. So any level stop they try to hit before making a rise, so that anybody who is trying to trade without a stop or without stop at entry, they try to bring in the margin call and then go up. So no trader at any given time can say that I am a smart trader, because the players are the smartest. Before making a big upward move, they will make a big downward stop and that is extended stop and. So if you try to trade without a hedging or a stop, then the only possibility is take only 1% of your equity, the position. Suppose you have got about $10,000, take one mini lot and just wait if you intend to trade without a stop, so that they cannot give you margin call, and you can keep a limit and wait. And once they close your position with the limit, then think of another trade. That way you can do it, but slowly you will be able to build up your equity. Then David, with the Cyprus issue and Slovenia and Italy issue, where do you see Euro Yen and Euro USD to go in this week? When you talk in terms of Cyprus issue, Slovenia issue, Italy issue, where is the question of yen coming to the picture? Okay, euro, which is the single currency for them, so you can understand that euro could be influenced. Where is the question of yen being influenced in that? So you have to think about it. And also, this is not the first time we are coming across issues from Europe. No, we know very well that Greece issue and Spain issue, so many issues have been seen in the market, and so many such remarks have come in the market, and ultimately how euro behaved. And you know that Greece issue, they took euro to 1.20 level, and now Cyprus or Italy or Slovenia, and they will try to confuse the traders, create the bearish feel or create uncertainty to that of the traders. And suddenly if some positive trigger comes and they spike up the market, and even if there is a negative event which happens out of this, then they will simply say technically the market has already discounted that particular event, so not much of a drop is expected. They can just give any sort of interpretation. So if you think that you have to do an in-depth analysis with regard to Cyprus and economy, and Slovenia and its economy, and Italy and its economy, and in what way it is going to influence euro, and in what way it is related to European economy, Japanese economy and things like that, you will become a very good economist, but not a trader. In JP Nambia, is extended move also referred to a quick move? Is there any other quick move? Yes, all quick moves are false move, and extended downward or an upward move is a false move. That means they just create the market sentiment using such quick move, so that the traders become stunned and they become helter-skelter and try to close out of the position, out of crisis management. Otherwise it may attract margin call. Later on find that what they had done is the height of stupidity. And every time the traders feel the same, but they are not able to control it, and they fail to understand all happens because of over trading. So avoid over trading, you will not be put under the stress. Kiwi follow Aussie moves. It is not necessarily Kiwi has to follow Aussie moves. If that is the case, then both Kiwi and the Australian dollar or New Zealand dollar and Australian dollar should be making the same net change. So Australian dollar is making 19 pips net change and the New Zealand dollar is making about 16 pips negative net change. Then you find that Aussie New Zealand dollar cross is with 3 pips positive net change, because there is only hardly any difference. Both are making the USD gaining move. But what the players do normally is they make the contrarian move among that of Australian dollar and New Zealand dollar. And most of the time what they do is they gain quickly in the case of New Zealand dollar when Australian dollar is staggered, and later on drop New Zealand dollar when they want to rise Australian dollar. So if you understand the rhythm by which they make the moves, then you can do Aussie New Zealand dollar cross as well as Aussie USD as well as New Zealand USD. Okay, then Edwin. Does high or low created between 2:30 and 3:30 GMT from previous day have any importance for big players? Yes, they do have that importance as far as the weekly moves are concerned. And if you go to my trading system, webinars which are recorded by FX Street and displayed under my profile in fxstreet.net, you'll be able to understand that the banks have got the limitations with regard to the spread, what they can do it. The net change, they can make about 150 pips on the downside or on the upside in a given day. So in a week they can make about 350 pips up or down. So after making, say for example, 150 pips upward move, 150 pips upward move for the second day, they would have covered already 300 pips. Then only 50 pips they can just make further rise, and the rest of the days they have to make only swings within that particular range. So this limitation, if you could understand and then use the initial lows and the highs set on a daily basis, then if you compare it, you will be able to find out whom they are trying to trap. First of all, you have to identify whether they are trying to trap the long holders or the short sellers. For that, the initial lows and the highs of each days are important. Say today's initial low is 1.27, and tomorrow, for example, if the initial low is 1.28, day after tomorrow initial low is 1.29, then we understand that they are trying to trap that short sellers. Instead, if the initial low is 1.26, 1.25, then 1.24, you know very well on Friday all the long holders will come for liquidation. This is a simple method of understanding. Then, would you repeat what you said about CAD CHF? Yes, Canadian dollar and CHF. You know that cross. What they had done, you know that Canadian dollar about 2-3 months back, which has come above that of parity, whereas the Swiss franc has still not come above that of the parity. So this is one of the cross wherein you find the two denominators are taken into consideration. CHF is a denominator currency, Canadian dollar is a denominator currency. So when they have come to 95 area in the case of USD CHF, then it is a USD gaining move. So when it is USD gaining move, you expect USD CAD to go up further as a USD gaining move, whereas they are dropping it. Why they are dropping it? Because I don't know whether I have this cross CHF CAD. So if you refer to CHF CAD, the cross will be CHF yen is there, sorry, it is not listed, which is one of the commodity cross. So they try to in CHF CAD Canadian dollar will be the denominator currency, which is stronger, and whereas CHF is weaker by against US dollar. As a result, you will find that CHF Canadian dollar cross, the denominator is stronger when compared to numerator, so you will find the weakening of that particular currency, the cross. That is how we have to identify, because suddenly they come to that particular cross, the commodity crosses, and make big moves there. And each time they select two crosses and handle them in a very big way. So you have to identify which cross they are trying to pick up today and focus on that. You will be able to really grab good profit. Many of the traders, they continue to trade in euro and find later on that, oh, I could have taken a position in GBP. Or when they continue to take in GBP, they find I could have taken a position in euro. Most of the time you come across the traders grumbling that I could have taken a position in euro yen rather than GBP yen. And suddenly they will say, no, yeah, GBP yen is a good currency. It has made about 200 pips rise or drop, whereas I am struck in euro. That is how they try to create such moves. But if you identify which currency they wanted to handle, now for example, euro is in negative net change, USD yen is in negative net change, and GBP is in positive net change. So they are making a downward move in the case of euro yen, and later on they are expected to rise, first euro yen and later on GBP yen. You just watch it. You will be able to really get the insight by looking into that other live market code page rather than looking at the respective charts. Then you will be able to identify or perceive the importance of the live market code page. Then Chowket. Shift in trading zone happen in this month? Yes. And you will come across the first quarter is over and they are accumulated against their sell what they had done it during early January. They quickly gained the levels and booked exited out of the buy position what they had taken during year end, and then dropped the market and accumulated during the end of first quarter. And these buys, they will try to exit by making a quick rise in the market. So it is a buy time to participate in a big rise, and afterwards you can book profit. Those who are doing currency conversions, they can simply accumulate the buy positions in euro, GBP and USD yen, and also USD CHF, and later on see big profits they can make by third week of May. I meant do those highs and lows act as targets? There is no question of target. First of all, keep it in mind that the players are not interested in targets. The players are not interested in showing levels. They wanted to earn money. So whatever the level they show, which has got a purpose, not to simply show the levels, it has got a purpose of creating the market sentiment and acting against the traders so that they continue to make money. So simply if you think that, okay, 1.2814 is the target, so they reached the target and nobody is going to reward them, simply they reached the target, or they go to 1.37, that was the recent high, and simply if they go and nobody is going to call them and say that you have done a great job, so we will reward you. The reward is nothing but the profit. So if such words are used in the market, and they are all mainly to trigger our emotions, simply telling that the target, etc. And ultimately what you have to see is, if I take a buy, where exactly I can exit and how much of profit I can earn. So focus on your trade rather than the entire market. When you focus on your trade, you will be able to really develop the insight. Then all personal questions I'll answer separately. Then Vinay, if initial low is broken and comes above it in less than 30 minutes, do you take position immediately or wait 30 minutes? See, if you are a small trader and if you want to have a safe trade, then when they breach the initial low and come above that of the initial low and stay there for 30 minutes, you can take the buy. And if you are a smart trader and you are able to really find the tricks, then you can take the positions as soon as they stop cutting the low for about 10 minutes. So no more questions, so I'll wind up the webinar. So I have given you the three type of analysis we make use of in order to understand the market, namely the derived forecast and the market reading, and use the trading strategy to limit the risk and maximize the reward. And expected market moves for this particular week, I displayed it, and this webinar is being recorded. You can refer it on a daily basis and find out how exactly that could be used effectively. And also the initial lows and the highs, I have just shown it, and only in the case of USD yen they breached the initial low. All other currencies they have not done it so far, and now from up to 7 GMT is the late session, so they just made a brief downward stop in the case of yen. See, 93.83, that was the low they are shown, subsequently they have gone up. So now we can understand how they are making stop-ins, creating the fear to the traders, and they make the stop end by using specific sell orders so that they don't actually sell in the market, but subsequently they accumulate all the stops. So they are targeting on the stops of the traders. So instead of stop, if you use the hedge order, your position is not closed, only that hedge is filled, you can exit out of the hedge with no loss, no profit by stop at entry, or with a nominal loss of 1 or 2 pips, so that you can continue to trade and you don't become victim for all their tricks. Then swing and firm up is expected during Japanese session, a small dip during start of the European session, and firm up is expected during late European session. Swings are expected, nominal swings are expected during US session. From today onwards, we will come across Japanese session gets over by 7 GMT, then 7:30 GMT European session starts. That is a change with regard to the market timing. You can make a note of it. And I'll come back on 4th of April, coming Thursday, and try to review the forecast what I have given it, and also explain to you what the market is expected to do during the BOE and ECB interest rate decision times. So I take this opportunity to thank FX Trade for the facilities provided, and also you people for the interest in listening to my webinar. And I want you to find the truth in my concepts, and if you find they are convincing, you can make use of it and try to use it in your trading decisions. Thank you one and all. See you on Thursday.